Welcome to Smith Weekly Discussions, an occasional program for our members of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience at Smith Weekly, including Brian H., Cindy W., Ryan S., Sean M., and Mark R. We have a new guest on the discussions program today. Miss Rita Adiani is with us. Rita is the president of Titan Mining Corp. The company is a zinc producer with operations in New York State with its underground Empire State Mine. The Empire State Mine complex currently has a mine life of about 9 years, with 2025 production of zinc estimated between 64 and 69 million pounds, with further production increases in the coming years, along with significant exploration opportunities within the existing complex. Titan Mining also is advancing its strategy to be a domestic supplier of critical minerals through graphite production coming from the Kilbourne graphite deposit discovered within the Empire State Mine complex area. Titan Mining is part of the Augusta Group of companies. Titan Mining is listed on the Toronto Stock Exchange under the symbol TI and also on the US OTC markets under the symbol TIMCF. Miss Adiani, welcome to Smith Weekly Discussions.
Well, thanks, Andrew. Good to be here.
Yeah, Rita, it's great to have you on for the first time, and we have lots to talk about, including what Titan Mining is up to. But to start, and since you are new to the program, just give us your resume and experience in the junior natural resource markets and why you took the job at Titan Mining.
Thanks for the question, Andrew, and thanks for having us on. My background is I am a lawyer by training. I've practiced for 5 years within the UK context at one of the largest firms doing corporate M&A. I then went on to become a banker, an investment banker, largely on that mining M&A front at SocGen in London. And then I moved on to a gold platform, which we initiated, which today is called La Mancha Resources, as some of the folks might be familiar with, where we used to look at assets which were undervalued, take them private, and then seek to monetize them after turnarounds. So that was more on a sort of producing scale basis. And my last role was actually Senior VP of Corporate Strategy and Development at Arizona Sonoran, which is a copper developer in Arizona. So needless to say, I've sort of transversed from law into banking, into private equity, into, running operations. And in all cases, really, the focus has been creation of shareholder value. When I was approached by the Augusta Group and by Richard Warke, who a number of the listeners might be familiar with, it just seemed like, an opportune time, largely because they sort of brought together my full skill set, which is dealing with production assets with significant upside potential. And obviously, the graphite prospect within the existing mine complex, as you've outlined, was very exciting. And more importantly, it's just the value at which Titan currently sits at. From here on, we certainly see the ability for the company to re-rate significantly. I think the distinguishing factor here for us really is we are a producer. We're not just an explorer who looks to sort of keep raising money for their programs. We have a full operational workforce, which we'll obviously come to talk about. We have people, we have infrastructure. So it is really a very exciting time. It's kind of being within a startup, a very small footprint, but we see great strides and leaps ahead in front of us.
Rita, thank you for that. Quite diverse background there, and certainly all of those components that you've been working in throughout your career are very important to the industry to run a company in the junior natural resource sector. You definitely have to have all of those components of expertise and experience in order to have any form of success here. So I appreciate you going over your background there. And of course, the thing that sparked your interest about Titan Mining, it's certainly a company we followed for a number of years here and have watched quite a bit here. And it's always been an interesting one from this desk. Rita, I'd like to ask you how you look at the market here for zinc and graphite. That's the focus of the company. How you see the market today, how that's evolving out there, especially with differences in the global stage here. What do you think is the opportunity now for both of these metals? And of course, Titan is focused on US domestic and potentially North American focused production, development, and exploration. But just talk generally about the market and how you see the opportunity.
Sure. So putting this into context, Andrew, as we know, zinc is, it has been defined as a critical mineral across the board, but the fundamentals of zinc and the uses of zinc really are still about 60 to 70% of the use of zinc really lies within, more traditional industries such as galvanizing of steel. And, the end users really are between construction, and infrastructure and for just things which actually the industrial metals complex has been known for. In terms of where the zinc market currently sits, and if we look at what Woodmac projections are, I think you'd come on to see that the zinc market in volume terms probably has 1 to 2% overall growth rate. It really it doesn't quite reflect the supra growth rates, which effectively you begin to see in the copper sector, largely driven by electric vehicles and other transformation technologies. So zinc is part of that base metals portfolio, I would say, but the uses to date outside of zinc air batteries are really being driven by the traditional uses. So what do we see and where do we see the opportunity? First and foremost, as we know, zinc pricing has seen a significant amount of volatility effectively. And I think there are, people who've been around long enough for the last 5 to 10 years where zinc hit highs of close to sort of, 160 a pound effectively. And today it's trading at 129 to 130. And then has also, sort of fallen down to the lows of about a buck or $1 per pound. So from our perspective, where we see the biggest opportunity now is that zinc is sort of, almost reached a landing point, which isn't too hot and it's not sort of below the marginal cost of production for most producers. So at 125 zinc, we're pretty happy with it from a pricing perspective. But where we see the biggest opportunity really is from a TCs and RCs perspective. And I think, people are well aware of the TC market, and in China, where effectively TCs are running at a negative, i.e. the smelters are actually offering people money to get that product as opposed to the other way around. So there's a lot of tightness on the TC market, which again, because there's a lot of tightness on the downstream side, we kind of see that translating into some sort of pricing power. And where we see Woodmac coming out at is definitely, staying above the sort of 135 to 140 per pound in the short term, and in the longer term, probably around the sort of 135 per pound landing. So zinc for us is our business. It's effectively our source of key cash flow. So at 135 per pound, we're pretty happy with it. Because, as you've kind of seen, our cost base sort of averages around 98 cents. So we kind of see that base as a good platform for us to generate a decent amount of cash flow to be able to invest it in growth. And, as we expand our zinc operations, to do things in a very measured fashion and continue to generate consistent cash flow. And I think that sort of sets up the stage in our thinking of how we really approach growth, because we see it as, hey, a good landing to have significant and decent amount of cash flow. I think if we look at our projected EBITDA over the course of the next 3 to 5 years, we kind of look at a base case of 20 million EBITDA, high case of about 30 million based on that 135 per pound. That's our view of the zinc market. And I'll kind of stop there, Andrew, if you have, if you think you want to chime in with any other comments.
Why don't you shift over to graphite and just talk a little bit about how you're seeing that market, because this also provides an exceptional opportunity if things can go the way that we would expect. Just talk about graphite market.
Sure. So on the graphite, really, I think that the key thing with graphite is, China is the biggest producer of graphite. 77% of graphite production, which is base production ranging from concentrate all the way down to the value add products, is actually led by China. So in terms of a price setting, benchmark, really China sets that benchmark. Um, and there is very little transparency on it. So it's not a traded metal. But what we're currently seeing is with all of this, and again, we are based in the US. I'm based in the US, and most of our management team is based in the US, although we do have, a significant presence in Canada as well. Where we kind of see the opportunity is with onshoring of supply chains, and really this complete incentive which the US government and other governments now have towards creating their own domestic supply chains. So for us, really, where we see the market is, being a key source of supply to U.S. consumers. And effectively, the way we look to position ourselves in the market is across a broad spectrum of end products, not just EV products. Because I think the misnomer around all of this is EV is great, but no one outside of China is producing EV anode material. So, from a breaking into the marketplace and being able to have a sustainable business, just because China actually has so much pricing power, it's almost worth doing things which are more niche and more specific, whilst having exposure to the EV space, obviously, because I think as we move towards electrification globally, the penetration will require more graphite, largely because of the anode inputs. But that is not the be all and end all of our case. So where we see the graphite market having real opportunity is one, us being based in the United States, being a key supplier of graphite. Just a point to note: there hasn't been a graphite producer in the United States since 1956. So the United States imports 100% of the graphite, and therefore, with all of this talk that we see of tariffs and all of this talk that we see of onshoring, we kind of see this as an opportunity to position ourselves quite uniquely. So that's our first probably differentiator in terms of how we see the graphite market. But B, really, I think where we also see the differentiation for ourselves from a marketing perspective and from a sustainable business perspective is being able to have a decent cost base, and largely because we have an existing zinc operations and we're looking to add graphite to it. So it's a kind of core product line for us. So when we look at, hey, how are we going to survive against China? Really, our two shields is one, first and foremost, producing high value products domestically. So not having to deal with tariffs, not having to deal with logistics issues, not having to deal with price volatility in terms of other supply chain issues which might come into play, which have cost factors. And obviously, the second thing is being able to produce at a competitive rate where our customers believe that buying from us is not going to put them in for a far less profitable position than buying from a Chinese competitor. No one is ever going to be able to match the Chinese cost structure, largely because of labor costs and energy costs being so much lower in China versus the Western world. But we believe we do have a competitive pricing offering for customers, and that's where we kind of see ourselves in the graphite market.
Rita, appreciate you going through that, and certainly domestic supply chain is a big deal for any country, and of course that resource independence, to the extent you have the land and the industry to be able to have that. I know some countries are disadvantaged that way and don't have that availability, but certainly North America and the U.S. Specifically here do have that capability. Very interesting market. And then also towards the end here, I want to shift back to graphite. Why don't we keep on zinc? That's one of the most immediate important things here, especially you guys just had recently announced results coming out of Empire State Mine. Cover off all of those results and how you see the rest of the year coming in specifically for zinc operations, because so far it's looking quite good. And then we'll get into a few more details.
Sure. So really, in terms of of where we came out at for the last year, I think, we, as everybody knows, that there were some issues due to suspension of the mine, due to Storm Debby, which was obviously a tropical storm, which is again one of those once in a lifetime events. And we seem to be living in the era of a number of once in a lifetime events. So that did cause some suspensions of productions back in 2024. But the one thing is, we managed to not only come back from it, but meet the higher end of our production guidance, which was, close to 60 million pounds. Where we came out at in terms of cash cost really was, at that 0.94 per pound. So that sort of brought us in pretty competitively in terms of where we're able to position ourselves and where we kind of see the next year coming forward. And what that really did was, give us enough confidence to be able to say, hey, we've been through some difficulties with the zinc market operationally in the past, but we've kind of set ourselves very well. Because the workforce is now not only a committed workforce, an installed workforce, i.e., all of the 135 people are there and they're there to work, but also, sort of those who kind of know the mine well enough so that when we do have once in a lifetime events, we're able to work through that in a team-like fashion to be able to achieve our objectives. So that I think is very important to highlight that, we do find ourselves in not a very populated part of the country, which is very close to the Canadian border, but we have managed to establish a very loyal and very committed workforce. So that kind of, the results were very encouraging to us from that perspective. Where we ended up in terms of cash flows from operations, it was about 16.5 million for the year. And that must note that is after paying about $22 million in debt payments. So we think we had a pretty good year, 2024, record safety year with, the safety stats coming in 70% lower than the national average, despite being, a deep underground mine. As you referenced at the start of this session, Andrew, we put out a new technical report with a 22% increase in measured and indicated pounds of zinc compared to the 2020 mineral resource estimate. And obviously also declared a maiden resource on our graphite project. So it's kind of been a busy year on the zinc side. And the two key takeaways from that is, we think we're poised now operationally for an expansion, largely because our workforce is now solid. We've established enough of, operational headroom ahead of us. So keeping that in mind, I think we can probably move over to the zinc expansion unless you have other questions.
Great. I appreciate you covering that off. And, it appears to be a great start to the year, even with some of the troubles in 2024. You guys did okay there. And it looks like more progress coming in the months ahead. Before we get into that, I'd like to back up here because this is an introduction program. I'd like you to, I think this is important, I'd like to cover off first the capital structure of the company and then get into staff in a moment, Rita. Cover off where we stand right now on the balance sheet in terms of cash and debt, and then also the outstanding shares at the company, and then major shareholders, including yourself, the board, and the management team.
As you've outlined before, we obviously listed on the Toronto Stock Exchange. The symbol is TI. Our cash position as of December 31st was about 10.2 million, and everything that I say other than the market cap will be in US dollars. It's about 10.2 million US dollars. We have about $10 million of third-party debt, which is bank debt with National Bank. We expect to pay that down this year, so we will be third-party debt-free. We do have about 22 million owing to our executive chairman and key shareholder. And again, we're working through that to see what is the best, repayment mechanism for that. In terms of shares outstanding, we have 136.3 million shares outstanding with a market cap today, I would say, because of, thankfully the results have kind of translated into, good feedback from the share price and a market cap today of about 60 million Canadian dollars. So that's where we sit with respect to our capital structure. In terms of shareholder ownership, Richard Warke, who is the key principal behind the Augusta Group, and as you know, we are part of the Augusta Group, owns 54% of the company. There is 36% owned by some institutions and other retail shareholders. The board and management currently own 5% of the company, and BlackRock also owns about 5% of the company. So overall, we have a tighter shareholder base than you'd see in most companies, but we believe that it is a very, very supportive shareholder base. And obviously, the key for us is to continue creating shareholder value. I wholly believe that the success of the company really comes down to a very disciplined capital structure, which is tightly held, but held by the right stakeholders. So we always welcome new shareholders, but again, we're very cognizant of the fact that there have been shareholders in here for a while, and really our duty is to create shareholder value.
Appreciate you going through that. I think it's important to point out how you guys have set this capital structure up, even despite some of the choppiness in the years in the past here, and then of course the major ownership held by insiders at the company, especially Richard there as well. Interesting capital structure. How you guys have been able to keep this where it is today, and of course the cash flow has always helped out with that as well. On the personnel side, cover off the key people that are supporting you and Don Taylor and what they bring to the table.
So on the personnel side, I'd say, starting from our board, our executive chairman is Richard, as you're aware, Andrew, and for the benefit of the listeners. And Richard's obviously a key part of the mining industry and has been for over 30 years, so he requires no introduction, I would say. The CEO of the company is Don Taylor, who again has had significant successes, very strong geological background, technical background, and operational background. You obviously have myself, and from a board perspective, we have I would say, from a US perspective at least, some very significant political support from Speaker John Boehner, who was the 53rd Speaker of the US House. He was a Republican speaker. Governor George Pataki, who was the governor of New York, and Bill Monroe, William Monroe, who is a senior advisor to the Blackstone Group, but has been a banker by trade, and used to be the senior advisor to Andrew Cuomo, who is the mayor of New York. So from our perspective, from a US perspective, we're very, very well represented, but very well advised when it comes to any form of governmental or permitting issues or anything of the like, largely because of the presence of Speaker John Boehner, Governor George Pataki, and Bill Monroe, as I've said. And obviously we do also have Len Boggio, who again comes from an accounting background, but obviously very well represented and sits on various boards. So again, we're very glad to have that very strong oversight and leadership, both combining the Canadian side and the US side. And then as part of the management team, we're very well supported by certain members of the Augusta Group, such as Pernie Parekh, who is a Senior Vice President of Corporate Affairs for us, Tom Latner, who is our General Counsel, and Joel Rowe, who is our VP of Operations and has been with the company now for over 7 years. And Joel actually lives in St. Lawrence County. So the way we kind of see ourselves is, across the board, we have a presence in Canada, and we have a new VP of Finance who's recently joined us, who is Kevin Hart. Kevin, Pernie, and Tom sit in Canada, sit in Vancouver. Great support, both from, a day-to-day perspective. We have Joel, who sits in the United States, and Don and me as well in the United States, and Joel really at site. So, both from a corporate perspective and from a operational perspective, are very well covered. And then obviously, as we mentioned, we have another 135 people who sit behind us and do the daily work. And of course, we're very glad to have that support from the employees and from the local community.
Rita, how you guys have been able to retain some of the staff is beyond me for such a small company. So well done on that front. And then also the mine, there's such a history of operations at the mine. So the 135 folks there on the ground, quite a history of this mine. Encourage folks to look into some of the history here. It's definitely been there for quite some time, and it's a big support to the local community there in that area in northern New York State, which is sparsely populated compared to the rest of it. So Rita, just talk briefly about the Augusta Group. Titan Mining is part of the Augusta Group. There's a few other companies out there. Just talk briefly about the group and their support for Titan.
Sure. But there are three companies currently within the Augusta Group. One is Titan, the other one is Augusta Gold, which has a feasibility stage gold project, Gold Reward in Nevada, and it's more of a precious metals play. And then we obviously have Highlander Silver, which is led by Daniel O, which is, very high grade epithermal silver in Peru. A brief history of the Augusta Group is, it is a group which really has excelled in identifying deposits globally, I have to say. I mean, some significant amount of success in the United States and South America. And, that has included companies such as Ventana, Augusta Resource Corp, which was obviously, transacted with Hudbay, Equinox Gold, and Arizona Mining, which again, as folks are aware, might have transacted with South 32. So the group has had a very, very good track record of identifying great assets, putting people and putting expertise around them, raising, funding around it in a very, what I call a disciplined fashion. So not, just mindless issuances of equity, trying to find creative ways of doing things. And just, pointing back to the history of the group, some of the returns, Ventana Gold Corp was sold for, I believe, about 1.6 billion. Arizona Mining was sold for about 2.1 billion. So they have resulted in significant, value creation for shareholders, and that has been the track record of the group. Obviously, Titan is a producing company and has been for a while, but we see the track record of the group being very consistent here. It is a creation of shareholder value and stakeholder value, really. Yeah, and we hope to replicate that with Titan. I think we're on a strong start, and we have been, so we hope to continue that.
Rita, thank you. And certainly the group has had a lot more successes than it has failures here. And so and some of the returns are quite fantastic. And we've certainly been around for some of these successes in the past, or heard of them, or in some cases been part of them. And important for the audience to take a look at the group and do a little bit of research on some of these other companies for evaluation purposes. Rita, just staying on the zinc operations for a moment, the company has plans for increasing processing to about 5,000 tons per day, which is within the existing operational capacities at ESM. And also nearby exploration work is ongoing to replace depletion and also increase resources and also increase confidence as well. Obviously, keeping that underground inventory ahead is always very important for underground mining operations. Talk about that work and the milestones over the next couple of years to see those improvements realized.
So just by way of background, we have a 5,000 ton per day mill, as you said, Andrew, and in fantastic working conditions. So there are some great photos of it on our website, and a good walkthrough, which kind of gives you a idea of what our mill footprint looks like. It's over 231,000 square feet. So it's a pretty big footprint there. And then we have a shaft, which really goes down to 4,000 level, where we're currently mining 4,100 feet. That is a 3,800, 3,600 ton per day shaft. So, given all we see with us and around us at the moment, this was announced recently. For 2025, we see the ability to ramp up production by, up to 15% above 2024 levels. So that is probably going up to about 69 million pounds using all the existing infrastructure. There is no new, big capital equipment items which need to be spent. And because we have all that existing infrastructure, all we've ever needed is, mobile equipment effectively, which as we know, can be secured quite cheaply, can be secured, on a very cost-effective basis, through leasing or other arrangements. So we see the ability to move up to about 69 million pounds this year. And by the end of, I would say, probably at the end of 2027, we kind of are looking towards hitting about 80 million pounds of payable production. And that obviously translates into about 95 million pounds of actual production because, The payability factor on zinc normally averages about 85%. So where we look at, currently going from 2025, or if we work back from 2024, all the way from 2024 to probably 2028, we see ourselves comfortably being, in the 2,800 tons per day processing capacity, processing performance. And that is largely because, everything that we see ahead of us really, both at the number 4 mine and the number 2 mine, which is part of the existing complex and part of the area that we're continuing to mine now, allows us to do that quite cheaply, allows us to do that very safely. That's a very important part for us, very consistently. And when I say consistently, that obviously means, what we want with an underground mine is some certainty of grade, because as we know, 5% grade won't really cut it. So we're keen on maintaining our grade performance effectively, for the next 3 to 5 years within what we've been at, and adding to it. So that's the sort of landscape as we see ahead of us, moving up to probably, 2027, 2028, and being able to move up production to that 80 million pound level. No major capital items required, and therefore we're very comfortable that, through existing cash flow or other capital structure initiatives, we can get there.
Yeah, very good to see some of these efforts to increase efficiencies and continue to replace depletion, and also ramp up a bit more to that capacity at the mill. All very good things here. And one of the other things as well, Rita, is I think it's important to point out here is the overall prospectivity of the existing about 80,000 acres of mineral rights the company holds within the ESM complex. Talk about that exploration potential, Rita, and where the company would potentially first look to test further mineralization outside of the current production areas.
Sure, and thanks for bringing that up, Andrew. I think, as you mentioned, we have about 80,000 acres of mineral rights. So, it's just a matter of time before we find the next sort of, big deposit, which allows us to fully utilize our 5,000 tons per day mill. So really, in terms of exploration, we see 3 key areas on a near-term basis, and then obviously I'll come to talk about the regional exploration potential. So on a near-term basis, we do have areas within our existing mining areas, which is what we call the number 4 mine and the number 2 mine, where we see zones plunging to the northeast, the ability to, continue with underground exploration there. One, from a resource replacement perspective, because the one thing to note is, as you would have seen from our 2020 mineral resource report and our technical report, which we put out in 2020, we had 7 years ahead of us. Today we have 9 years ahead of us. So we continue to add every year, and not only add by the amount that we've depleted, but by more than that. We continue to add equal quality tonnage or equal quality inventory. So the grade is not sort of dipping, significantly. So that remains a key focus for us. So we see opportunities for that within the existing mine. And then, within that existing footprint of the number 4 mine, we kind of see, I'd say about, 5 to 5.5 million tons of mineralized material, probably at 10 to 14%. So our current inventory is about, just let's call it in terms of contained resources, about 1.5 billion pounds, including measured and indicated and inferred, and we see another 1.5 billion pounds ahead of us. So in terms of near mine resource, we continue to see significant exploration upside. And then regionally, we obviously have, a significant footprint. And what we're looking at doing is, this year, I think we have 30,000 feet drill program, which obviously includes surface drilling as well as some amount of underground drilling. And I think, the purpose with that is to look for deposits which are close enough to form a hub and spoke approach. Those that are, easily accessible, and those which actually can be trucked, or those which actually can be, hauled effectively to the mill because of the excess capacity that it has. So we continue to invest in both near mine and regional exploration programs. And given the history that this district has had, as you mentioned earlier, it's been, a 100-year zinc producing area, and we continue to see that, going long into the future. So from a zinc only perspective, we do see, again, summarizing this, going up to 80 million pounds probably by 2028, end of 2027, early 2028, which is within the next 3 years. And then the ability to find something really quite exciting and quite big, from a regional discovery perspective. And the good thing with all of this is we're a producing mine, so we're not raising money for exploration, and it's all being done from, free cash flow from operations.
And just part of that, what do you think would be, well, first of all, I think it's good to point out here the goal of adding another, billion pounds is quite interesting. What do you think would be, given current operations, obviously sustaining capital needs, what do you guys think you would be able to do if you had conditions that you would expect, or maybe conservative, Rita, given the market out there? What kind of money do you guys think you could allocate over the next couple of years towards some of these outside existing operations, potential discovery areas that you guys have identified? What do you think could be done, and what do you think the timing of that would be potentially? Just talk a little bit about that.
I mean, this year we're spending about $2.5 million on exploration, which is just the regional, surface drilling. What we're looking to achieve is something quite significant, Andrew, because, the one thing for us is we own our surface drills. So the cost of us drilling is about $21 a foot. So if you can imagine what we can do with, not only our own drills, but we have our own operators who obviously have expertise enough in knowing what we're doing. And, with the amounts that I've outlined, I think there is significant prospect of us discovering something, assuming, we follow the right footprints and have the right geological mapping done. There are great chances of us finding something which will then allow us to, add that to the mill capacity and therefore be able to, bring up production to well above 100 million pounds. We're the number 4 producer in the United States. So to be able to continue to incrementally add and, sort of continue to deliver to the supply chain would be a great thing.
Absolutely. So we have existing operations which are being optimized, and then of course we have the exploration potential on the zinc front, and then of course potentially other mineralization as well, because this leads us into the graphite discussion here in just a moment. So you have that component of it, so existing production, cash flows, exploration on the zinc side, which could lead to further discovery. And then I'd like to get into the Kilbourne graphite deposit, which the company discovered in 2023. The deposit area about a kilometer away from the mill, roughly, to just the area. The project is envisioned, Rita, to be an open pit operation using the existing mill facilities, of course, retrofitted to produce a graphite product, of which is to be determined in terms of finished grade yet. Rita, cover that off for us and the plans to add the graphite production to existing operations at ESM. Just talk about this discovery, and this is another big portion yet to come in the pipeline.
Sure, Andrew. So I think this is what we call ourselves as we're built for growth. And the reason is we obviously, as you mentioned, we've now established a very strong operating platform with the zinc business. As you say, we see upside within the zinc business itself. But really on the graphite side, this was in 2022 where, our guys were exploring our own property just as you do, and found traces of natural flake graphite. And it was, something that we didn't quite expect, but it was something that we recognized, and our geological team sort of decided to take a little bit further. So we did good amounts of metallurgical test work against, the drilled components of it. And what we currently have is, as you mentioned, is an open pit constrained 43101 inferred resource. It's about 22 million tons at an average grade of about 2.91%, containing about 653,000 tons of contained graphite. The total strike length that we see is about 25,000 feet, but we've only tested about 8,300 feet. So call it about 30% of the trend has been tested. And the reason we kind of stopped there is because when we looked at the pit outline, we wanted something to be sort of, pretty comfortably sit within our what we call the active use permit. So the resource which has currently been outlined sits within our active use permit, and as you've very kindly sort of gone through for the clarification of listeners, what we're talking about here is not a deposit which is outside of the mining complex. So we see the potential for expansion along strike, around down dip. But the reason we kind of stopped at where we are is, first and foremost, we kind of see this as open pittable. So in terms of economics, it's definitely more attractive. But we didn't want to go down a route where if we're to fast track this to production, we didn't want it to be a 3 or 5 year process. We wanted to get into production as quickly as possible, and therefore, having something within our active use permit, which only requires state level permitting for the purposes of mining, makes it a lot easier to get into production. Obviously, keeping in mind that we have the existing infrastructure and the operational workforce to do so. So that's where we are, and that was a discovery, as you said, which was made in 2023. We put out an inferred resource towards the back end of last year in December in 2024, and we're continuing to advance on that. And I know Andrew will come to talk a little bit about the upcoming developments on that.
A great potential bolt-on here to what you guys have there at ESM, and it shows also the prospectivity of other minerals at the site there as well. Just with respect to, and I know this is preliminary, Rita, and I know further studies, of course, economic studies need to be done at 43-101 compliance, et cetera. Say what you can here, but what could we expect potentially on a conservative production profile here? Maybe you can speak to production costs, the expected sales price, depending on how that turns out as well. I know more testing is needed there. And then as well, CapEx for the project to add that graphite circuit, and how you would go about financing that. Would there be government grants involved? Just talk about how you see those things and the timing as well.
So the first phase with all of this, and I think there are, just because again, our goal and our duty is to maintain our existing business and add to it. So we're not going to do anything which jeopardizes our existing business, because, it's something that we have experience in, expertise in, we have an established offtake partner in Glencore. So we don't want to do anything to jeopardize that. So really from what we're looking to do with the graphite business is we will be launching a commercial demonstration facility later on this year. It'll be a processing plant, a mini processing plant, which is going to be co-located within our existing zinc plant. We'll probably have a very small ball mill, very small cyclone, and a bunch of polishing mills and cleaner circuits. But that will be housed within the existing footprint, producing about 1,000 to 1,200 tons of graphite concentrate annually. We expect that to run for about 12 to 15 months. And the key purpose of doing that is to generate product, which effectively goes into qualification. Because what we don't want to do is effectively, set up the parameters for a plant, or set up the parameters of something which we know, A, we cannot finance, and B, we have no customers for. Because again, as I mentioned, graphite is almost, it's not a freely traded metal, let's call it. It's not a metal, it's more in concentrate form. So the commercial demonstration facility will not only help us set the full path to full-scale commercialization, but will also help us get, defined offtakes for volumes and for prices. And based on the initial testing that we've done, we obviously know what the spec of our material is. And on the basis of that, we have, a conceptual plan where we look to produce about 20,000 tons of natural flake graphite in the first phase, and then 40,000 tons in the second phase. So those are just broad production metrics, which will really follow the commercial demonstration facility, which we expect to launch this year. And when we launch our 20,000 ton plant, it will be off the back of defined offtakes. It will be off the back of, customer contracts where we kind of know what spec they want. We know they have our product, we've qualified our product. So it gives us a good amount of certainty that as soon as we've put in all this capex to start producing it, our payback is sort of pretty high on it. It's not something which we just invest capital in and never see a return. Because again, we don't want to be taking on debt unless we can justify the payback on it and anything leading to jeopardizing of our zinc operations. So that's where we broadly sit in terms of production metrics and the pathway forward. And I'm happy to go into economics, Andrew, if that's what's next.
Yeah, Rita, that would be great. And then also, just so the audience understands, the graphite market's a little bit unique in the sense of how offtake works, the different specifications for the finished product, the different applications, of course. And so far, I think you guys, want to go through this test phase, which is really important to demonstrate the quality or at least the range of products that could be put out here as well. So yeah, go ahead and go into the economics and cover off anything else here. I do think this is very important to get across, and definitely this is a focus, and this is pretty near term as far as at least the demonstration portion.
And again, to clarify, the demonstration plant is not something, which carries a significant capex burden with it. And that's largely because we have the people. There is no additional fixed cost or labor cost associated with running this. We have the people. In fact, some of the equipment, we're building at site because it can all be sort of, fabricated. We have great engineers and great workshops. So for us, it's a sort of low capex or low entry outlay, let's put it that way. And in terms of that's on the commercial demonstration facility. In terms of what we're targeting as operating margins, at 40,000 tons at an average selling price of about 2,350, 2,400 per ton, we're targeting about a 40 to 45% margin. So if we just take full numbers, and just for the sake of simplicity, if we're looking at 2,350 and we're targeting a 45% margin, we're looking at over $1,000 in margin. So just broad numbers, you're looking at, probably $40 to $50 million of EBITDA effectively. That really is on the 40,000 ton facility because, there is a ramp up involved with it. So those are the sort of broad operating metric targets that we're looking at.
What do you think would be, I guess we're going to slide into permitting here. I was going to ask you about that, but the permitting side of things, but also the timing. So once demonstrations done, we've got offtakes to deal with, going through these initial stages of demonstration. What do you think the timing would be to get towards a commercial facility permitted and off and running, ramped up?
Yep, so we'll be putting out a PEA this year. I expect it to be towards the back end of this year. And the PEA will obviously outline the full, CapEx estimates together with OpEx estimates for the graphite and for the graphite together integrated with the zinc operation. So that sort of lays out where we see the synergies. We'll be running the commercial demonstration facility alongside that. We will be submitting our mining permits, which is all that we require to undertake this expansion and adding this co-product line, as we call it, probably starting in September of this year. And it's about a 12 to 15 month permitting process. So we expect to run effectively the feasibility study in parallel with the permitting. So once we're done with the feasibility study, so if we just think about it in terms of timelines and targets, we have 2025 for release of the PEA and for running of the commercial demonstration. 2026 we have permitting and feasibility running in parallel. And in parallel to that, we're obviously running the funding process. So really looking at, probably FID by the end of 2026 with plant startup at some point during 2027. And that obviously, Andrew, as with everything else, depends on, construction timelines, depends on availability of equipment. But from factors within what we control, we really are targeting 2027 to be able to be up and running whilst obviously continuing to produce product for the next 2 years from our demonstration plant at pretty full runtime. And I think that's the important thing with graphite, that This is not something which is a pilot. It really is a big demonstration facility, and we'll be producing product at full runtime where we're able to get customers onboarded.
Even with the lead times on special equipment that needs to be ordered, this is pretty fast. And then also, Rita, just, I guess that speaks to the existing operations, the existing infrastructure, and of course, existing operational expertise that can help out here. So I think those are all key components to help move this down the road relatively quickly here. Just speak a little bit to why we're on the topic of just the permitting side of things. One of the things you guys obviously have a lot of expertise in and a lot of local folks to help out. Just talk a little bit about community, the support of the community to add on this project, of course, and then existing support for the mine. I mean, this has got a long history. And then on the government front too, just cover off those relations. I'm assuming they're very good, Rita, given some of the staff there at the company, but just talk a little bit about government relations and your expectations there as you guys move this forward.
No, happy to do that, Andrew. And I have to say, I spend a lot of time at site, largely because, that we don't really believe in having multiple corporate offices and the like. I think we at the moment we operate a very lean structure, and we always will continue to operate that way. But from our perspective, in terms of community, the 135 people that we have are largely from the community. So we are a big community center, let's put it that way. We have fantastic support from the St. Lawrence County, including the Development Authority there. We have most of the colleges. We have a good deal of support there. In fact, this year I think we put out about 4 internship adverts, and we got 17 or 16 people wanting to sign up. So we do have, we do attract a lot of people. We attract a lot of young folks, which we as we all know, is very important for survival, if not, the flourishing of the mining industry. And more importantly, we do have a big military base next to us called Fort Drum. So we're very well served effectively by the community. In return, we are obviously very cognizant of the role that we play. So obviously we do undertake a number of community programs, and everything that we do, we maintain a very transparent relationship with the regulators, including the NYS, which is the New York State DEC, which is responsible for our permitting. We started with 80 people back in about 7 years ago, back in 2018, and we've ramped up to 135. And I think, the community is happy to have us, and we, again, are very well supported by them.
Good to know you guys have community alignment as well as government alignment. Of course, existing operations, much easier to get additional permitting done, amendments done. And of course, there's that ongoing compliance that occurs on that front. So it's good to have those close relationships. Rita, just back to what you said on the margins on the graphite side of things. Just speak a little bit about how, with those margins and padding that's in those margins, my suspicion is the graphite market, and again, this is not an area we've done a lot of research on, Rita, I'll happily admit that. The graphite market, I'm assuming, is a fairly sticky price, and that we don't have too many concerns going forward given the supply issues out there, existing capacity, especially domestically. I'm assuming the graphite price, depending on what products, are fairly sticky. So just speaking of the downside, if you were to attack the project, Rita, just talk about the robustness on the downside of the project if we did have some type of situation, which I don't foresee in the near term, where graphite prices drop substantially.
So happy to do that, Andrew, and I think that's a very important component of how we look at the business. I think, as you mentioned, graphite obviously has had this great incentive of benefiting from onshoring, from benefiting from a local supply chain. But at the end of it all comes down to the cost structure. If you're not competitive in terms of cost structure, you're just never going to be able to survive it. So the way we see the business, and I think and you've outlined it, we have a product mix. If we were to bank our house and all our cards on going down the EV anode route, we can achieve probably between a revenue or an average sales price of between $5,000 to $8,000 a ton. But to get there, your production cost is probably going to be $3,500 a ton. And then you're competing with China, because obviously, China is the big swing factor in this equation. So if we were to only pursue that, effectively we have a high operating cost base. And on top of that, if we're able to convert that, then the profitability factor plays in really well, and you end up with, big NPV and great output. But again, big NPV doesn't always mean the project is going to get funded. And more importantly, effectively, even if it is funded, you will be able to pay back the debt. Again, we take a slightly more conservative approach. This is a core product line for us. So from a graphite pricing perspective, we've factored in a very conservative mix of products. So just by way of example, if we were just to sell the graphite concentrate from where it comes out today, and we know there is sufficient demand just for the concentrate could go effectively into certain segments which have demand today. There is no one servicing that demand locally. We believe we can, deliver at a price point of about, say, $1,300 to $1,400 a ton, effectively. To be able to, get a decent return from it, I think, say we produced at $800 a ton, we would certainly be able to make a $600 per ton margin. That into 40,000 tons can give you about $24 million of EBITDA, give or take. So that is where we see the downside. The upside is effectively for us being able to do some value add at low capex to be able to reach that $2,400 a ton price point. To your point, I think where, again, the graphite market is very variable, largely depending on what product spec you're targeting. But the one thing which we're not doing is banking the house on EV anode pricing. And secondly, what we benefit from is synergies on the cost structure with our zinc operations. So overall, our goal is maintain minimum downside, just like anyone else. But more important for us is, do nothing to jeopardize our existing operations.
Appreciate you going through that. I think that's always important for investors to weigh, is that downside robustness. And of course, you guys are going very conservative here, and you're not planning on putting out a very rich product to start anyway, and want to see that potentially happen. But the conservative nature of the approach, I think, makes a lot of sense here as well. The potential for these cash flows adding to the existing production profile is certainly fantastic, and quite a step change for the company as well. Well, Rita, I really want to thank you for your time today. It's really been good to have you on the program and introduce Titan Mining. I know it's been a long time in coming, and glad to have you on here. I'd like to leave it there for now, but I'd like to just have you close out with this question here. For potential investors who are listening in, the company has a market capitalization of about 57 million Canadian dollars. Why should Titan Mining be considered within the institutional, family office, and retail investors portfolio at this stage?
Thanks for that, Andrew. I think the reason I always recommend people do something is because I've kind of done it myself. And there are two real key factors where we see Titan having a differentiating factor vis-a-vis other projects, vis-a-vis other companies, be it in the zinc space or more importantly in the graphite space. First and foremost, you have the benefit of existing cash flows. You kind of know that when you buy into the stock, you're not buying into something that you're going to get constantly diluted into, unless there is, something which really does carry significant equity value, which requires funding. That's point one. And point two is really the characteristics of the graphite project, which we've outlined here today, which I hope will, give some people confidence that really, Titan's biggest growth story is just about starting. So the way we kind of see it is we're at an inflection point. We've kind of been there, and where people have said, prove it to us, we've kind of proved it to them that we can be an established producer. We have been. We have the support of a great community. We have the support of a great workforce. And really what we're doing is looking at leveraging all of that to diversify the risk from a commodity basis, but also to become basically one of the first producers of natural freight graphite in the United States since 1956. And I think we can deliver that probably within the next 24 to 36 months. It's not going to be an easy ride, But we obviously promise to try our hardest and do our best. And again, we're all shareholders of the company, so we take our balance sheet is kind of linked with those of new and existing shareholders.
And what is the best way for investors to contact the company for further information?
We do have the contact details on our website, which is info@titanminingcorp.com. And then, Andrew, if you get any inbounds, obviously you can feel free to refer them directly to me. I'm happy to have a discussion.
Rita, we'll do that and really appreciate the time again today to introduce Titan Mining to our audience. Best of luck with work at the company in the coming months, and we're hoping you'll come back later this year to update.
Of course, happy to.